Hello and welcome
LFG people
to
Fintech Insider,
Blockchain Insider,
11FS Spotlight,
11FS Explores,
Open Mic Night,
After Dark.
Through our podcasts, videos, newsletters, and live events, we have a direct line to a truly global fintech community. So if you're looking to sponsor and collaborate on content that connects with everybody from fintech beginners to the biggest VCs, then chat to our team at sponsors@11fs.com or visit 11fs.com to find out more.
Long live the community.
Hello, it's Benjamin here, Director of Research and Strategy at 11FS. Earlier this year, we published Building the Future of Home Buying, a report that calls out financial services for making the biggest, most significant purchase of most people's lives way more difficult than it needs to be. Well, fast forward to today and things haven't changed. Mortgage offerings are more important now than they have ever been, with sky-high interest rates in many countries forcing home buyers to shop around. We've got clients asking us how to move quickly to fix the problem and get a game-changing product to market. Want to know the secret? Step 1, download the report at 11fs.com/homebuying. Step 2, get in touch at 11fs.com/ventures. Speak soon.
Hello and welcome to Fintech Insider Insights. I'm David Brear, Group CEO here at 11FS. In today's episode, we're examining the concept of fast following. Is this something really that is possible? It's something that we hear a lot from clients or different organizations. And is it always a bad thing? Is that strategy something that people should be a little bit of ashamed of in 2023 or not? How can you get this right? What pitfalls to avoid? And much like the recent episode that we did, myself and Ewan, talking about actually how you put the services back in financial services, this is something really we want to just have an inside of 11FS conversation about and open up that conversation to you guys, our listeners. A, because it's super interesting. B, just so we don't have to keep repeating ourselves, quite frankly. We're going to have something of a bit of a fireside chat. And actually, if I welcome to the show, Jason Bates, who is Deputy CEO here at 11FS. It's something, Jason, me and you talk about pretty frequently, isn't it?
Yeah, it's always interesting when you talk to a new client. I mean, we've spent the last 7 years building new fintech propositions, new banks, new approaches to market for some of the biggest incumbents in the world. And inevitably, they point at a local competitor and say, we want to do one of those. So, you know, it's the default position, I guess, the fast following.
Yeah, and I know, I mean, from early days of our relationship, actually, you know, when you were back in your Starling days, in fact, I remember you saying a few times, you know, you'd go to a conference and talk to them about what you were doing at Starling or what you're doing at Monzo, and they were like, well, if that goes well, then we'll probably just copy what you guys are doing, you know. So it's an interesting context, isn't it? But maybe I guess if we start with, you know, what is a fast follower? Like when somebody says, well, should we just be a fast follower? What do they mean by that? Because I guess there's both a positive way you could think about that and a negative way that you could think about it, I guess.
Well, I guess I'm going to go to the oracle of all information, ChatGPT, that says that a fast follower is a company that quickly imitates the innovations of market pioneers, often improving upon them to gain competitive advantage.
Interesting. So I guess, I mean, speed is a big part of that, isn't it? If we're to believe, what ChatGPT says there. But I guess that's always been my sort of gut reaction to why I don't think that strategy works in a big incumbent organization is that typically what they mean when they're going to do a fast follower is they're going to take all of the features that they've seen somebody else do without any of the understanding of why they do them or the benefit that they really bring to a consumer, and then plug them into a waterfall change process that 2 years later might spit out that feature. And that doesn't really benefit the customer and doesn't really benefit your internal organization in terms of really understanding why you're doing what you're doing, right? So, and fundamentally, I guess, fails on the fast point of that definition, doesn't it? In terms of, you know, quickly following what somebody else has actually managed to achieve. So is that fair, or am I being difficult?
I guess you have to look at what are the underlying capabilities that make you a great fast follower. And ultimately, that's about execution. It's about process. It's about being able to deliver faster and iterate faster, forgetting somewhat about the innovation and the creating and the kind of lean startup, let's do experiments, and focusing more on the other side of things. Actually, execution is the key to success in many of these things, not having a great idea at the start.
Yeah. I mean, that's an interesting challenge then. I mean, is this a byproduct of organizations actually just being slow at change more broadly then? So, is this people sort of almost, you end up wearing the T-shirt that you've got. Is it a strategic decision that they've made to be a fast follower, or just by the nature of their big organizational waterfall processes, do they have any other option than to take that approach?
It gets complicated here because if we're talking about small innovations, small improvements in process, small optimizations, then even large organizations can roll those out fairly quickly. If we're talking about changes in an operating model, especially in heavily regulated industries where you've got the life savings of millions of people and regulator scrutiny to make sure that you're not creating problems even with that innovation, then that's something different. And I think we're always at that discussion of, are we really just digitizing what came before, or are we creating this new digital operating model, which actually you can't fast follow as a large incumbent most of the time because you're just not made for doing that.
Yeah. And I guess that push there then, I mean, this isn't necessarily a bad thing in that context, as you say then, isn't it? The place not to be innovative, bizarrely, given all the changes that are happening in the market, is your core banking systems or your risk and control processes. Like, let's be really non-innovative in those things. Let's have them incredibly stable. Let's have them incredibly boring, right? So banks have got this sort of a bit of a dichotomy there, haven't they, in terms of actually the pressures on them. In some senses, those systems of record need to be, ultra bulletproof and slow moving, and so they should be. But actually, really what we're talking about here then, the model fast following worked when actually the market wasn't moving fast. Is that fair?
Fast following works when the market isn't moving fast.
Yeah, so I'd say really if you look at that as a strategy, and actually if I look back at my career at Lloyds Banking Group, from 2008 to 2012, I mean, it felt like everything was changing, but really nothing was really changing, and not nowhere near changing at the same pace as it was today. The competitive landscape was different. The people in the market was different. The organizations that I was worried about when I was the green one, and there was somebody in some red ones and some blue ones and whatnot. Actually, the market was moving so much slower than it is today. And actually, if you stand back from the competitive landscape and really everything that's happened, like, actually, can you afford to be late to the market with changes? What I always feel, and we always say this, I know when we talk to people as well, Jason, is like, there's sort of two things you've got to kind of always care about, when you try and get to the end of a project, is like, have you delivered it in the way that you said you would do, and does anybody care? And I think the challenge with being a fast follower is, like, actually people, to your point around execution, I think every bank has really smart people who see problems and actually see opportunities in the market that go, hey, the ROI, the investment case for this thing would be really significant if we can make it happen. But actually, if you never get to market in time to realize the opportunity, can you ever really, what are you following people to? Are you following to the ROI of an investment case, or are you just following to market parity? Because if your aspiration for your organization is just, we're about as good as everybody else is, it's like, well, I'm not sure you can still be marketing yourself by all of the things that you're marketing to be for the customer, if all you're actually aiming at for is just to be not as any worse than anybody else.
Yeah. Look, I guess when we're talking about a slow moving, mature market, then we're really talking about slow following. And that's great, especially if the forces around regulation and making sure your organization of 40,000 people stays together and coherent, then actually disruption is a really bad idea. Actually, you want to put in all of the controls and processes and organization to make sure that the steady state isn't disrupted, because that's the steady state that's actually providing this vital utility. So if the market changes, and if underlying societal changes then change what the optimal delivery model is. So suddenly it's not branches and phone lines and letters, but it's actually real-time intelligent banking services, then that's a fairly hefty change. And all of the controls that you put in to make sure that you don't disrupt the service that you've created, this vital utility, are then obviously anchors to slow down the change that you can deliver. So it's, part of this is, and going back to the kind of Starling Monzo days, when you talk to a banker and he says, well, what product are you selling? And he's working from that product distribution paradigm. And we say, well, actually, it's a current account with a little bit of overdraft lending. And they go, well, that's not great. Good luck making money with that. It's missing the fact that we're moving on the retail banking side towards these services that do work for people, this private banking for the mass market, the 10 times better service for 10 times lower cost. And that ultimately, if that is the future, then iterating to that, being a fast follower towards getting there rather than just providing a prettier statement and a better form design for signing up to a new account is quite a big ask. And I think that's where the intricacies, it sounds great, like we should all be fast followers, but you've got to look at what are the forces that are preventing that. And some of them are there for good reason. So then the question is, well, how do you become a rapid execution, scaling organization that has the capabilities in order to do that safely, but rapidly?
Yeah. And I guess to that point, I mean, when, nobody was really doing anything in the market and the market was, slow moving, as we say, then actually, I mean, the impact to the customer is relatively minimal, isn't it? Because, the feature parity is almost, somebody does a thing and then, slowly the market moves in that direction, right? But what really is the impact for a customer, an end consumer? And actually, I mean, I guess that impact on consumers on the banks as well, right? I mean, in a consumer experience perspective, we sort of see, early innovators, the people who want to be experiencing, the best and the cutting edge. There's always that crazy guy on the iOS beta, right? There's always that person. But actually that does apply with financial services as well, right? People are looking, particularly as fintech has got cooler and cooler over the years, then there are people who will disappear from one big bank to a fintech, or even from one fintech to another fintech because they're doing more innovative things, right? But I guess from a bank's perspective, I mean, they've been doing this for years. This is not just about experience. This is about product as well. And I mean, like old-fashioned financial instrument, not just product as in a product management sense, but tweaking product features. You turn on the taps for bringing in customers or exiting customers potentially if your risk profile shifts, right? So, but the end consumer, I guess, is impacted by this ultimately, right? I think, as you said earlier on, we are increasingly in financial services kind of what we do rather than just what we say, which I think is a good thing, but I guess the impact on end consumers, if you are a fast follower and you are, by nature a lot slower to release new capability and bring things to market, I guess inherently there are risks that come with that from a security perspective. There are, experiential benefits, the niceties that you could have that are problems as well, right?
So there's so many factors in whether customers are going to change to a new product or not, and whether being a fast follower is a good idea. Because in the end, that's all about timing. So we've had this fundamental underlying shift, or we're in the middle of it. We're moving from the analog digitized kind of, here's your monthly statement printed and sent to your house, to a world where we can get that in real time and we can add technology over the top in order to do real work for you. And we're seeing that disrupt a variety of industries, whichever industry you look at. Suddenly that real-time, intelligent, contextual, just-in-time service via some kind of technology, whether it's smartphone, desktop, TV, whatever, is here. And so then the question is, well, how does that affect our industry? How does it affect retail banking, insurance, and investments and pensions? And so if you're the big incumbent, then you don't want to go out and put your brand at risk in terms of doing crazy experiments that people might look at and go, wow, why is that company doing that? That's not going to work. And no one signs up for it. So a bit like Facebook, Google, Meta, you look at the market and you see what's working, what's gaining traction, what's out there. And as long as you can either buy that company or copy it quickly, then arguably you're looking for the signal within the noise in order to say, actually, there's going to be something there and we can jump onto it. So in the UK, for instance, we had that wave suddenly of everyone saying, well, look, digital banking is never going to be a thing. It's not going to work. People value the in-person interaction. They won't trust small brands, all of this kind of thing. And suddenly we've got these outflows from big banks to the new players. And so then you get an organization like Chase comes along and basically does something pretty much similar in their brand to what's in the market already. Does it really quickly, doesn't do an MVP, doesn't do a beta, just launches the an equivalent digital bank. And they've got obviously a large organization behind them. They've got lots of capital. They can sweeten the deal. They can start to pull customers in. So for me, that's a good fast follower strategy. You execute it hard, fast. You make it so that when people log into the app, you go, actually, this is kind of what I expect. It does just what it says. And they're giving me this cash back. And it's a really big organization that isn't going to lose the money. Great. Here we go.
Yeah, it sort of starts to tick a lot more boxes in that sense in terms of the competitive landscape there. But I guess, Chase is an interesting one, isn't it? Because they've obviously, this is the second or third time I think that, JP Morgan Chase have attempted to build something like this. And I often say it's sort of not what you do, it's the way that you do it. Their products, okay, like their challenger bank, status tick, but actually it's the things that underpin it as an operation that make it unique. They're the things that actually mean it can, yes, it followed into the market, but they're the digital operational capability. They're the things that actually means it can sustain what it's doing. We're going to take a quick break and pause very quickly. We'll be back with you shortly. Hey folks, we have super duper exciting news. The shortlist for this year's 11FS Awards is officially live. We asked you, the incredible Fintech Insider community, to help us choose the deserving winners of the 11FS Awards, and your response was outstanding. You voted in record numbers, and it's now time to see if your favourite fintech companies made the shortlist. With a total of 10 different awards up for grabs on the big night, including categories like Best Experience Design, Fintech for Good, Best Use of AI, and Consumer Game Changer, there is a lot to look forward to. Don't wait, explore that full shortlist now at 11fsawards.com. That is 11fsawards.com. And be sure to stay tuned to all of our channels to find out who will take home one of the coveted 11FS Award trophies on Wednesday, 15th of November. So I guess, Jason, picking up really a little bit on what we were talking about just before the break. We talked a little bit about fast followers and actually in what circumstances it sort of makes sense and sort of doesn't make sense. And often these debates are semantics, aren't they? But semantics, as an organization who draws a large distinction between digitized and digital, we shouldn't get too hung up on calling people out for a semantic argument in that sense. But actually, I want to sort of dig a little bit deeper into what we sort of mean by that, though, because I think there is something sort of underpinning this that's actually quite important, which, I've been sort of quoted as producer Laura said, you said this thing, can you explain it? And I've been quoted as saying, feature parity is not product parity. Explain. So what I kind of meant by that is, actually, I think the shift, as you've described, towards more of a service-led, we talked in the last episode about putting services back in financial services. The services view, those intelligent services, that moving away from just those commodity products into those intelligent services, that structure, that for me is a purpose-driven mandate of financial services. And the people pulling those things together within the organizations that are really driving in that direction have an incredibly clear view of the customer's problems. They have a very incredibly clear view of the problems that they're solving, the way in which they go about solving those things. It gives everything that they're doing meaning. And actually the challenge, and I don't mean that in like a, oh my God, like hands, like post-it notes and hands wavy design process. I mean, like, actually, we're really clear about the problem we're solving. We're really clear on who this is for. We're really clear on actually when we get there, what we're doing next in order to build from that. Product management in the new sense, being really embedded in that approach to delivering those things. So going back to that, it's not just what you're doing. It's not just the features. It's the way that you're doing it. It's the purpose-driven product strategy that you're pulling together, right? So for me, this is the big difference. I think big organizations still see what other people do as emulatable things without really considering how they weave into the tapestry of their purpose and actually the problems that they solve for their customers. And that becomes the challenge. I think anybody can blindly deliver things to their customers, but if you don't really understand why those things really materially benefit your consumer, or actually how they really tie into what your service proposition is, then that's where I think it becomes really dangerous. Because just doing what other people have done because they did it doesn't necessarily. It's that old. I remember Mum. It's like, look, if everybody jumped off a cliff, would you just jump off a cliff? It's like that narrative. Like, actually, just because other people are doing it doesn't mean it makes total sense, or that actually just bolting it into all of the stuff that you've already got means that actually your service proposition improves. Because, if we look at customer satisfaction as a good point here, it's like, actually, I reckon, Chase have done a lot of the things that Monzo's done, at least in the early stages, right? But I don't see their customer satisfaction numbers being close yet. Barclays have emulated a lot of the stuff that Starling's done, right? But the customer satisfaction scores are dramatically different in terms of it. So the features you deliver to your customer are not your product. Your product and your service proposition around that, what you stand for, what you don't stand for, what people believe about you as an organization. I think that's a much bigger thing.
I'd like to pull out two parts to that. The first is that it really depends on the maturity of your industry. You could argue that actually banks haven't had to do proper strategy in a few hundred years, because basically there's an optimal way of being able to at scale manage people's finances, and so we ossified around these current accounts, unsecured lending, credit cards, mortgages. Someone at some point had to come up with those products which were satisfying customer needs, making money, leveraging capital in the right way, and actually once that was found as like the optimal for that era, then you could kind of forget about a lot of the stuff above it. It's just like deliver that and do it well and operate that. So when things change, it's the classic sort of innovator's dilemma stuff. You actually have to go back to first principles. Anne Boden used to say, half of people in retail banking really don't understand how retail banking makes money, like the basics of capital, liquidity, risk, and how that sort of comes together. And then really what value we're delivering for customers and how that works. So if you can get back to the first principles, you say, does that really fit now? Or is there a better way, given we can have this instant communication with massive amounts of technology we can bring to bear in order to deliver better services for end customers? And so from that perspective, you kind of have to forget banking is really about these products because it's about these products. It's like, well, it was when the market and society looked in a certain way, but it looks different now. And so there's a new structure to this that we're going to have to find. So we kind of have to drop that and go to that first principles view, to the outcome view, to the meaning view. And to be honest, I still think we're a long way from that. Because while even the best challenger banks can offer pots and maybe a very basic salary sorter and the ability to have these real-time balances, they're almost components of a financial system rather than a financial system themselves. Like people who are good really set up their accounts in clever ways. Their joint account, the account they're saving for a holiday, something for an emergency fund. They're relabeling the accounts. They're doing all of that. But no one's really helping people who are not that into finance and managing their own money. So I still feel we've we've got to the point where we're giving people components, but there's steps further. So I still feel we've got a fair way to go on that. In that first principles, what are we really trying to do to make people's lives easier, to keep them out of financial difficulties, to help them make the right decisions, but to give them the freedom to make the wrong decisions if they want, as long as they know the end outcomes. So on one side, you've got and if things have changed radically, then you need to almost approach this, from the Feynman principle, first principles. What can we do? How does the financial technology work, the financial product? And then how do we deliver real value? On the other hand, you've got the intent. So, the NPS scores, there's something about, well, what are people delivering for me? And then there's another component of that do I think that they're doing this for my best interest? I mean, the obvious example being the NPS score for First Direct versus HSBC. Arguably on the same systems with the same people. Now, okay, maybe different call center approach, but First Direct is far better than HSBC in general. And you kind of think, well, that's just not about the kind of product as well. There's something beyond that. There is a brand halo around this, which actually gives people a benefit. So I think that there is challenger banks, arguably less tarnished from the financial crisis, and less of that, they're always after me for fees and charges. And to some extent, they can leverage that. They can actually have non-competitive products financially and still do better than the big banks. So it's interesting. I think that there's that sort of from first principles bit does break down into a number of areas.
Yeah. I mean, does that, that connectivity though between, it sounds so obvious when you say it out loud, doesn't it? It's like the connectivity between why are we doing this thing and then actually doing it effectively and then explaining why you did it. I mean, it just sort of sounds so obvious when you say it out loud, right? But I think there's a problem there though, which is if you are essentially just emulating what other people have done, do you really understand why you're doing it? And actually, that point that you make around, banks haven't really had to do, strategy in its truest sense for a while. I actually think that has changed. And I mean, we know this from the work that we're doing, right? The sort of the biggest strategy that actually I think everybody is really trying to come to terms with right now is, do we really understand our customers and what their problems are? Because actually in a market where the world has shifted, COVID and political unrest and, the world changing and I don't know, Trump, throw in whatever stuff you want to throw in at that point, everybody. Then essentially, do we really understand our purpose of the problem that we solve for our customers is a pretty big question, isn't it? In that way.
And where's the world going? I mean, year on year, you can put in a nice budget for an incremental change to match someone else. But ultimately, then you look at your systems and think, well, actually, my capital expenditure this year is just increasing my operating expenditure next year. I can't go on like this. So I'm going to have to make some moves. But to make those big moves, I've really got to have an idea or an understanding, a belief, a hypothesis on what the future is. Like, what is my investment thesis? And where do I think that retail banking or insurance or pensions or investments are going? Because then to some extent, I have to place a bet, or I have to at least have some optionality, understanding directionally where do I think this is all going to go.
Yeah. So I guess sort of, bringing to some sort of conclusion before we sort of talk a little bit about, well, then what do people do? Really, like, the argument isn't whether being a fast follower is a good idea or not. It's actually that the context of what fast is fundamentally different now than it ever was before, really. We're sort of talking about the customers are acting in a completely different way, which is essentially the food chain, right? We're seeing competitors move and, emerge in completely different ways, arguably who are all better equipped from a service-led propositional basis to, find product market fit and continually iterate on those things. But really the big shift here is going from, project-based, annualized, feature chasing projects to actually we've got to always be iterating, always be learning, always be moving forwards. And actually that shift is difficult, isn't it? This isn't just let's do that. That sounds sensible.
Well, it's also the iterating towards what? Because okay, suddenly you're on the investment committee for one of the big banks in the world, and there's 1,000 projects that you could do next. What are you going to pick? How do you decide? So you have to have some kind of hypothesis so that you know what you're going to say no to and what you're going to say yes to. Otherwise, you're doing 1,000 unrelated random things that all kind of move the organization forward or improve the customer experience. But it becomes less coherent, less focused. It's difficult to know what we should be looking for, what we should be doing, unless you've got some kind of North Star as to where to head. I think the other thing that we've not spoken about is fast following in different territories. Because when you look at an organization like Rocket Internet, which is arguably the poster child for fast following, they made a business empire, basically taking Amazon and then applying it somewhere where there wasn't an Amazon. Uber, right, here we go. And in financial services, equally, you could say, well, okay, Klarna, let's put it in Ethiopia or Indonesia or somewhere where it isn't already. So that view where you actually say, well, what is one of these models that works really well? And is there a place in the world where it doesn't exist yet? Off we go, boys. And, and away you go. So I think that's also an interesting opportunity, especially if you're a global bank, to start to say, well, what are the winning plays? And are there territories that we're in that one of these plays doesn't exist yet? Because, you're then taking a fast following approach to being a first mover. Win-win.
That sounds good. Yeah, I mean, I feel like a bank would like that as a sticker. Like, do you know what I mean? The idea of following global trends to impact. I mean, arguably, our success has been down to that to a certain degree. The changes in the UK to Hong Kong to then Singapore to the explosion of change that we're seeing in the Middle East right now. Definitely, if you've seen the movie before, then you're probably better placed to help. What the runners and the riders and the successes in that sense. But I guess to anybody listening to this, they're probably like, yeah, but our technology sucks. Like, so all of this stuff about fast following is great, but actually, like, we're talking about really why this is why banks end up iterating on the sprinkles on top of, rotten ice cream, when that's the only part of the process that they've really got leverage to. Yes, I can make I can change the colors and I can update my logo. It's why big organizations will prefer to do a big brand change than they will actually anything meaningful, because it's, well, yeah, I can just pay for new TV adverts or I can change these things in this way. But the actual underpinning of our, skeletal system of our bank is difficult to touch, right? So how much, I guess, Jason, is the speed, the sort of metronome of an organization dictated by the underlying infrastructure, the underlying technology set? I know we got into it a little bit last time with you and around Conway's Law, but it feels like that's such a fundamental, isn't it? But this is the real reason it's critical, isn't it?
Yeah, it's, it reminds me of that banking battlefield slide we use a fair amount. It's the Mark Andreessen quote: "Can large organizations, incumbents, transform faster than startups can scale?" And that transformation is a multi-decade process for a large organization with tens of thousands of people in a highly regulated industry. It's just a phenomenally difficult, long process, including technology, process, people, all of those classic big five consulting sort of operating model things. So what's the answer? As as we often talk to clients, they have to look at a portfolio approach to this, because they're not going to be able to transform fast enough in order to get to a point where they can deliver these intelligent digital services to millions of customers and iterate on them towards these, new, ever more interesting, ever more valuable private banker to the mass market style services. So what does that mean? You're partnering with new players, you're creating new players. There's some level of separation for a new operating model versus the old, as well as changing the old operating model. And so I think, I do think the reason for the innovator's dilemma, which is Clayton Christensen's hypothesis, or it's almost a paradox. Why do the largest players in the world with all of the brand capital, expertise, experience, staff, everything, how do they get overtaken by new players in their own industries? Like, you can point to 100 examples. Why does that happen? That seems insane. And the problem is that operating model change at scale is almost impossible to do fast. And so, you look out into the world and you've built a 10, 20, 50, 100,000 person organization based around a particular operating model of pre-digital banking. To modify that in time in order to scale, to transform faster than startups can scale, is arguably impossible or highly unlikely, unless some ridiculous CEO comes in and she decides she's going to just cut sways through the organization and make it happen. But there are relatively few of those. So I think you end up with that question. It's like, can fast following, can that transformation really happen in a large organization without a CEO and the backing of the board really going to town, really making it happen?
Yeah. And I'd say, probably the answer to that is no. And actually the challenge to that degree is almost, that goes back to what we were saying earlier on. I mean, in a market where people were not moving very quickly, then that strategy was applicable. But in a much more, as you've often said, the complex and chaotic, landscape, then actually the model today is, and really the only real differentiator that you can have is that you can see and solve customers' problems quicker than other people can. That might be the thing that attracts customers to you. It might be the thing that retains them with you. But it's definitely going to be the thing that actually determines whether your brand is just the stuff that we see on the side of London buses, or whether it's really the things that you deliver to your customers, isn't it? So that for me, I mean, that is what being fast is. Being fast is actually, it's a mindset as much as anything else, which I know sounds so hands wavy, but it's really what we mean when we say digital banking is 1% finished, and we say it's actually about the 99%. The 99% is not a list of features that you can deliver to tick off to achieve a thing. It's the realization that you're never done on this. It's always going to be changing. You've always got to be evolving it. You've got to be taking the things that you were great at that made you successful and sort of challenging them constantly, because you're only ever as good of what you do against the conditions of the market. And actually, we're in such an amazing time. The market is changing, for the better in many ways, radically. These things called interest rates, it's going to change the market in a really exciting way, right? New product configurations, new opportunities, new competing for customers on those things. It's a very different market now than it was before. But fundamentally, if you can react to the market and capitalize on those changes, you're going to be in a lot better place than the competitor will.
And I think that's it. We've grown up in a mature market, and we've learned habits, behaviors, and what we think are fundamental truths on how you do business. The long-term strategic planning, the McKinsey, 5-year plan, and this is how it's all going to work. The Harvard Business School, like this is how you do strategic management for maximum efficiency over a long period of time in a mature market. But we're not in a mature market now. We're in an extremely immature market. Technological advances, changes in society, interest rates, everything's up in the air. And so all of the kind of startup hand-wavy stuff, lean startup, agile approaches, small teams, microservices, you can look at those and go, well, that's just a bit of a fad. But actually, it's the new way, the new optimal way of doing business strategy and business management, because you can't predict more than a year or two or, however ahead. So all of those techniques and approaches that we just thought was how business was done just don't work as well anymore. And so therefore, from first principles, you can get to, how startups work or how you build technology stacks for maximum scalability, but also flexibility, the optionality, the building capabilities and remixing them because things are changing and we need to move quickly. So I think that underlying societal business canvas change then means that you have to approach this in a different way. And if your organization is optimized for the old way of doing things, maximum efficiency over a period of time, long-term planning, really that Gantt chart that stretches across the wall view, that's just not going to work when actually you have to rip it up on day 5 because someone else has launched something or ChatGPT comes along and we're into a new world. So I think actually that shift is not the trendy, or what a startup's doing, let's do that as well. Microservices, oh yeah, that sounds cool. Like, you've got to really look into why is that a better approach now? And I do think it's this underlying chaos and complexity and the number of players and the world that we're in that leads then to just a different way of doing business.
And I mean, we've sort of joked before, haven't we? I mean, fast following or speed or whatever, there's a good sort of kind of argument for various different parts of that. But I guess really what we're sort of saying is like, you can opt into evolution or you can opt out of evolution, and that's okay. Like, you can do both of these things. But
I think you have to do both. Like, I really do think that if I was, CEO of a bank somewhere, I'd be driving, good projects that show good business performance, like cut costs, improve the service that I'm giving to the majority of my customers. But at the same time, you have to know that you're going to have to jump that chasm at some point. You're going to have to get to a point where your organization looks radically different. And what is the transition there? Because I just don't think a large scale, long-term digital transformation is going to do it. So what's next?
Yeah, what's the answer? And really, I mean, the point I was going to make is it's not really whether you believe in evolution. Evolution definitely believes in you, So actually, those steps in the market, those changes are really critical. So, I think organizations looking outside of their own four walls are probably going to be more effective to be able to react to the market than those just purely looking inside. But all right, on that note, hopefully you guys found that interesting. This is the type of conversation that we have at 11FS quite frequently, usually over steaks, I think, with you, Jason, isn't it? Which is nice. But that does wrap up today's discussion. Thank you so much for joining us. Jay, where can people learn a little bit more about you? Or do you know what? If they wildly disagree with you, how can they get in touch?
Oh, yeah. Come and heckle me on LinkedIn.
Very good. As for me, you can find me predominantly lurking actually on the 11FS careers page at this moment. If you did like what you heard and you want to come and solve some of these problems, head over to 11fs.com/careers, where we've got loads of cool jobs going up to really bring in people who solve these problems and help us change the fabric of financial services. Thank you so much for listening, everybody. If you like what you heard, follow the podcast. Don't forget us to leave us a review. It really helps us make it better and helps other people find the show as well. As always, if you want to join the conversation, find us on social media. Just search for 11FS or Fintech Insider, or email us on podcasts@11fs.com. That's podcasts with an S. I always think I say that weird, but hey ho. Thanks very much for listening, everybody. Goodbye.